Let's bring in Bill Gross from California with Pimco. Bill, good noon to you.
Hello, Tom. Nice to see you.
You seem humbler. 6, 7, 8 months ago, you were talking about, and again, not to pin you down, but a higher rate regime. When will we see that? Have you delayed it down the road, or have you amended your call?
Well, let me amend the misery to a certain extent, Tom. I mean, we're not overweight treasuries, and we're certainly underweight treasuries, but that doesn't mean that we don't own lots of other bonds. I mean, bonds today, German bonds are rallying, and Canadian bonds are rallying as well, and we simply think those are better alternatives. It doesn't mean as well that we're not a little bit shy in terms of duration, but we're having a good year. You know, your numbers as of last night show us beating 2/3 of bond managers, so don't cry for Pimco.
Critical distinction here. You have not left the sovereign space. You've just left the U.S. sovereign space, and you're in other developed economies.
Yeah, that's correct, and it harkens, I guess, to recent papers by Carmen Reinhardt, who's done a great job with Ken Rogoff, as you know, with a book called This Time It's Different, but she's written additional papers, and, you know, it's sort of a follow-on to what we've talked about in terms of pocket picking and skunking. She calls it financial repression. What we're trying to do is find countries that are less financially repressed. That means countries that offer higher real interest rates. In the United States, for instance, the policy rate at 25 basis points, Fed funds, is about 300 basis points less than inflation. That, along with the examples in the UK, you know, are financially repressive, meaning investors earn a substantial amount less than inflation. We want countries where we can do better than that.
Let's look at two charts, Bill. First, dreaded first chart, personal consumption. What a disappointment today, and this was in the Bill Gross new normal mode. How is the American consumer? Do you see a sustained softening in consumption, or will we see a rebound to what we saw at the end of last year?
Now, we continue to see low growth, Tom, not just in the U.S., but globally. You know, on a domestic and global basis, I think it's clear that we're not building houses for each other, and that there are not enough jobs to go around. It's not that demand is satiable, you know, it never is. It's just that the financial system and the stability of existing systems to facilitate it aren't in working order. And because of that, jobs will go to countries with the cheapest labor, and policymakers will attempt to make their country the labor market of choice via financial repression and currency depreciation.
Okay, here's the real rate. I want you to tattoo this chart to your brain, folks. This is important. Bill Gross, get used to it. 2-year real yields. He uses a different series. I take the 2-year yield and I subtract the Cleveland CPI, which is the way the Federal Reserve Bank of Cleveland looks at inflation. Look at the sustained negative inflation-adjusted yield. I mean, Bill, this is remarkable. What does this mean for the savers, my viewers, getting crushed in the CD market?
It means that savers are being disadvantaged and will be disadvantaged for perhaps 5 to 10 to 15 years relative to debtors. I mean, what policymakers are trying to do is rebalance this imbalance in terms of too much debt and too attractive rates on savings. And what happened since 1946 to 1979 in the UK and the US in order to rebalance balance sheets was that the US basically capped interest rates at 2.5% for much of that period of time and offered substantially lower real interest rates. That's what's going to be done here, and basically it's called financial repression. We call it pocket picking. We simply suggest that investors look in other areas in order to achieve returns.
Should they buy equities and not bonds at the margin?
I think so. You know, our recent secular forum suggested a bumpy journey. We are in a new normal territory, but to the extent that G7 countries grow at 2% and to the extent that emerging and developing grow at 5 to 6, and those are our main level assumptions, then equities do make some sense. They do offer real returns in the form of a dividend yield that can grow of approximately 1.7 to 2% or more in various countries, and compare that again to real rates of interest in the United States on a 7-year of a negative 0.1%.
This is the 6 degrees, the 6 degrees of Bill Gross or whatever. Over here, look at this chart. Here's the bond yield back 12 days, and you can see us break through this resistance. And this is Bill Gross. Bill, we just broke a 308 handle. It's all because of you. You're on surveillance midday. We're at a 307.91 down here as Bill Gross destroys the market. How is he doing that? It's surreal. I mean, Bill, are we going to go under 3%?
Well, I don't think so. We've talked about this before. We've got the end of QE2 coming at the end of June, and that subtracts about $1 trillion worth of annual purchasing power the Fed will not be buying. And I would be the first to admit that I have that there's not enough data because QE1 and QE2 were such a short period of time to suggest what might happen afterwards. But I simply think that yields would probably go higher as opposed to lower, if only because we wonder who will buy treasuries when the Fed does not buy treasuries. Yeah. So at these levels, at these negative real interest rates, let's look to other countries. Let's look to corporate bonds as opposed to treasuries.
I just looked at our new HD monitor. Folks, your cable providers, ask them about Bloomberg HD. Because we just put up a totally cool statistic, the blow-up of the Fed balance sheet over the last 5 years from 800 billion to 2 point whatever trillion. Amazing. Chart 2, the long-term view. Bill Gross, this is a great chart, and it spans your 40-year career at Pimco. Wow, I'll buy a Starbucks coffee. 1955 to now, it's the H15 Federal Reserve 10-year yield. You see the Volcker peak there and the Great Moderation. Bill Gross, is the Great Moderation over?
Well, I think the Great Moderation in terms of steady and high real growth rates is over. I think the Great Moderation, to the extent that it incorporated high real yields, and it did since 1979 with the Volcker revolution, so to speak. I think that's over too. I mean, what we experienced over the past 30 years in terms of real interest rates is a 10-year that basically traded close to nominal GDP. What we've got right now is a 10-year at 3.06, which is trading, perhaps 1 to 2% under nominal GDP going forward. And so therein lies the difference. Savers are being disadvantaged, and it pays them to look for alternatives.
Bill Gross, thank you so much to get our show started today.